What if every dollar on the internet could earn safe, regulated yield inside the apps people already use?
It's going to be a multi-trillion-dollar industry. Every single dollar in that multi-trillion-dollar industry is going to want to earn a return and do it in a way that's embedded and safe.
But there's a catch.
Regulators this is something that they've done with e-money. There's always been a prohibition on paying yield because the assumption is that if you're able to pay yield, then what you're doing is you're taking customer money and making illiquid, risky loans.
Despite the prohibition, demand is undeniable.
I think last year they say that there were more stablecoin transactions than Visa and MasterCard in 2024.
Yeah, that's correct. And it's only growing. It's over $20 trillion of annualized transaction volume.
So what's the compliant unlock?
That means companies like OpenTrade need to exist to transform those stablecoins into yield-generating instruments.
And it isn't just for today's users.
Stablecoins are today the only money technology that's fit for that feature.
How does this reach billions?
One of your customers can get your product into millions of pockets.
From regulatory constraints to trillion-dollar opportunity, discover how embedded yield is becoming the internet's default savings layer and why AI agents will demand it. Join us as we explore the infrastructure powering the next wave of embedded finance with OpenTrade CEO David Sutter and Notion Capital GP Itxaso del Palacio.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund of fund managers, modern funds means going digital. Fundcrafts gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, SkyTech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to SkyTech this year. If you're gearing up for a next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Today, we dive into the mainstreaming of stablecoin yield, what many are calling the next evolution of embedded finance, and what I call witch speak, because I have no idea what we're going to talk about. No, I've of course done my best to research this, and Itxaso and David are going to help me a bunch. David Sutter is the CEO of OpenTrade, and Itxaso del Palacio is, of course, the GP at Notion Capital and an early bagger of the company. With 11 million raised in 6 months, millions of users across LATAM and Europe, and infra-grade scale, this is a story that's much more than just another fintech. It's about rebuilding financial access from the ground up. David, tell me, what exactly is it that made you think that the world needs stablecoin yield as a solution to today's problem in the financial system?
It's first of all, it's great to be here. And as you can imagine, it's not a straightforward answer, but I'll try to make it so. So my co-founder, Jeff, and I, we have been working on crypto and stablecoins since we were college students over a dozen years ago. We're working on some of the first versions of stablecoins and tokenization. And over the last decade, I've gained a huge amount of experience in that realm, and saw essentially what we're seeing today is an absolute Cambrian explosion of innovation around stablecoins. They're making dollars smarter, faster, more accessible. They're bringing dollars into the internet age. In the same way that Stripe probably looked at the explosion of the internet and said, you know what, everyone's going to need a checkout tool. We looked at the explosion of stablecoins and had what seems in retrospect the very obvious insight that everyone's going to want to have yield and embed yield, the ability to earn returns on their dollar and euro stablecoin balances, and to have that yield be embedded in the applications and tools that they already use to manage their financial lives. And so it was that sort of core spark of, look, we've been in this industry pretty much since it started. It's going to be a multi-trillion-dollar industry. Every single dollar in that multi-trillion-dollar industry is going to want to earn a return, and do it in a way that's embedded and safe. That's what we built OpenTrade to do.
Let me ask a follow-up question to that, because the yield problem with stablecoin is not a purely technological one, right? It's also that, at least in the States, you've had a long time where you would not be allowed to make money or make yield on stablecoin. Am I right?
That's absolutely correct. So just for the listeners out there, basically the arc of stablecoins is they started as a way to solve a very specific problem, which was that crypto exchanges were not given access to the banking system. And so exchanges needed a pair, one side of a trading pair, to be denominated in dollars. And so they started using crypto to do that. And then with the explosion of DeFi, these crypto dollars started to be integrated into sort of more mainstream financial services. And then the next phase was people started understanding that, hey, they were actually really good for sort of real world use cases, sending money, building banking applications and services, et cetera, et cetera. Throughout that arc, there's always been this issue that stablecoins, unlike a checking account or a savings account, don't pay you any interest. And your investment options have been basically either hold it and earn nothing, or invest it in crypto, which can be quite volatile and speculative at best. Because of the way that regulators have kind of classified stablecoins as a form of e-money, there's always been this sort of blanket prohibition on e-money and now stablecoins from paying yield. And so in that market structure, we saw great demand for a utility like OpenTrade to be built that wasn't issuing a stablecoin, but was taking stablecoins, transforming them into something that could generate yield for end users.
So Itxaso, now let's look to you and ask you, Notion is known for backing SaaS and infra leaders. What made OpenTrade stand out, and how did you come to feel comfortable with a crypto angle to this?
Definitely it took a little while. This is not the first company we are looking in the space, and we just made a bet in a couple of days. But yeah, anyway, it's great to be here, and Andreas, be back here, because I was with you several years ago in a completely different podcast. But yeah, Notion is, as some of you might know, is a business software investor. We've been investing in B2B software for more than 15 years now. And we backed a lot of the traditional fintech infrastructure companies like Currency Cloud, which was acquired by Visa, or GoCarless, Paddle, Griffin, and they are in our portfolio. So OpenTrade is simply providing infrastructure for this next generation of financial rails, let's put it this way, but it is still within the fintech space and its infrastructure, right? In fact, OpenTrade is not the first company that we are backing in the digital currency space. We did another investment a couple of years ago in a company called Figment, which is providing infrastructure for non-custodial staking. And we looked at a lot of companies. I tell you, companies providing infrastructure related, for example, with security solutions in the digital currency space, related to insurance in the digital currency space. So this is not the first company we are looking at. OpenTrade definitely didn't win the race because of that value proposition, which I do believe is very compelling. But it is also the current tailwinds in the market that are happening. I think many of you have heard of this thing called Genius Act, which is basically enabling or will enable many of the mainstream adoption of a stablecoin, and is led by the US government. Obviously, there is a massive transaction growth in a stablecoin. So I think, correct me, David, if I'm correct on this, but I think last year they say that there were more stablecoin transactions than Visa and MasterCard
That's
in
correct.
2024. Is that right?
Yeah, that's correct. And it's only growing. It's over $20 trillion of annualized transaction volume. It's at a size that shocks most people when they learn.
Correct.
Can I ask you just a question on that, a clarifying one? Is it volume of dollars transacted, or is it number of transactions?
Volume of dollars.
Okay. What is the driver behind that? Because what I've always thought is, well, okay, when machines make super small transactions and we need them to happen really fast, stablecoin is the natural good solution because you don't have the fees of Visa and stuff, which is what would then drive a bunch of small transactions, but not necessarily the huge ones. Can you clarify to me and the audience, what is it that drives this massive volume in the space as well? And maybe correct if what I said was just ridiculous.
Look, historically, the primary driver of stablecoin usage has been the crypto markets, which have obviously ballooned from several $100 billion to well over $3 trillion of market capitalization today. And that was the core use case, and still today remains sort of the lion's share of that transaction volume. However, what we're most excited about is all of the infrastructure, whether it's custody or wallets or like us yield, that's been built up to serve that burgeoning stablecoin economy has now made them ready to cross the chasm to mainstream usage. And so now you have tens of millions of people, especially in emerging markets, who are using stablecoins as a new digital dollar. And sort of the core value proposition, which is simple to explain and incredibly powerful, is that anyone with an internet connection can now, with a few clicks, open up a dollar account and send, spend, receive, save, and now with us, earn in dollars, and do that anywhere in the world, anywhere that has an internet connection. And that sort of general purpose value proposition is incredibly powerful, and is now, that's becoming an increasingly large share of what's driving that stablecoin growth is that core desire and need that businesses and individuals around the world have to do business and save and transact in dollars. And it's making it much easier and faster and smarter. It's making moving a dollar over the internet as easy as sending a text message or email, which is simple to explain, but incredibly powerful.
This has been the narrative around stable coins for a long time. But the last year, of course, AI and the fact that we're going to have computers interacting with each other is definitely also a driver. Am I correct? And could you, both of you, talk a bit about how important that is in this specific relation?
Yeah, look, I mean, I've been a huge proponent of this. I've been writing about this for quite some time. And that what you're referencing is that if you do believe in a future like I do, where sort of AIs and AI agents are going to become an increasingly large part of everyday life, then the natural sort of logical conclusion is that that AI ecosystem will need its own financial system, where AI agents and AI applications can pay each other and basically avail themselves of the same financial services that we as human beings do. And if you do believe in that vision, then what follows is stablecoins are today the only money technology that's fit for that future. And so they weren't built for AI, but because of their inherent characteristics, the way that they're built, the way that they run, the way that the technology works. They're really the only form of a dollar that is fit for that future.
Some say that with AI, crypto has found the solution. Crypto has found its problem to solve. Itxaso, can you tell me this rise of AI and this worldview that we're going to have computers transacting with each other in a much higher degree than we do today, is that part of the thesis behind your investment as well, or is that just the kicker?
To be honest, that's just a kicker. Let's put it this way. We are investing a lot in AI. Probably say 95% of businesses are AI native businesses today that we are investing in, and probably that we are seeing. However, I think within the financial fintech space, there are some regulatory barriers to entry that definitely create a very strong value proposition for those companies who make it there first and securely and get the regulatory power that makes them unique. So that wasn't part of the thesis. However, there is something that we haven't mentioned before, which is Circle's IPO last 2 months ago or 3 months ago, right? I know it's not even last year. And I think that definitely brings a lot of trust to the market and the price of the stable price and the growing price that is also creating a great opportunity for other investors to come in.
David, you spoke about it before. OpenTrade, you're bridging retail demand with institutional partners. I'd love to understand, what does institutional grade infrastructure really mean when you're serving end users in countries as far-flung as Argentina and Colombia? And how do you think that a product must protect both the retail on the retail level, but also what you need on the institutional level?
That's a really good question. So our business model is B2B2C. And so our customer is typically a regulated fintech provider. That means that they have a pretty high bar for the standards and the quality and the safety of the products that they integrate to then offer to their users. And so that institutional grade standard starts with our legal framework. So the idea of bankruptcy remoteness, that all customer funds and any cent that moves through our software is segregated and held in very large, creditworthy, regulated financial institutions, that none of that money is ever commingled with the operating cash or the creditors of any of the service providers, including ourselves, involved in the flow of funds. That then dovetails into cybersecurity. So we have independent cybersecurity audits and pen tests on every line of code that a customer ever interacts with. And that is all kind of wrapped in a very high level of customer support, where, literally no job is too small in our business. I, as a CEO, am on calls with customers late into the night, holding their hands through any issues that they might have, making sure that the product is operating exactly as they expect it to and exactly as they need it to. So I think sort of the legal protections and the quality of the financial institutions and counterparties, the cybersecurity, the robustness of the cybersecurity protections and preparedness, and then ultimately customer support to make sure that our customers, those are kind of the three pillars of what we consider to be institutional, and we offer those to the highest quality, the highest of standards.
Tell me a bit more about that decision to grow via distribution partners, meaning existing fintechs, rather than going direct and building it.
The inspiration was sort of right in front of our eyes, and it was with USDC. A lot of people don't realize you can't open an account as an individual with Circle. Circle serves the fintechs that then serve the end users who are interacting with USDC, and it really changes the cost base of your organization. It means, in simplest of terms, one of your customers can get your product into millions of pockets. And ultimately, the value proposition, one of the key value propositions for us, is that our customer can ultimately maintain control over the customer relationship and the economics of that relationship, and the brand that customer interacts with, and the user experience that customer interacts with. So, we've seen Circle do it extremely well with USDC and others like Stripe, as I referenced before, that sort of uses that B2B2C distribution channel and to great success. And so we saw it work with USDC and figured, why wouldn't it work with yield on USDC? And so far it's paid dividends.
Itxaso, you've done a bunch of B2B investing. How is, and of course, massively successful with Go Cardless, Paddle, New Life, as you said earlier. How does this model of B2B2C compare to that? Why do you like it? Where do you maybe think that is difficult? What should you think about, both as an investor and a founder in this space?
We love B2B2C models. The principles of selling infrastructure, particularly in the fintech space, on the B2B or B2B2C, whatever you want to call it, models doesn't change significantly between the traditional fintech and this next gen digital currency space. However, there is a fundamental difference, and I think Dave will agree with this, and the buying behavior. So if you think traditional financial institutions, how long do our companies knock off the doors of UVAs, HSBC, a POC, and moving forward and integrations, right? So selling to exchanges, custodians, neobanks, and any of those stablecoin issuers becomes much more agile because they are less risk averse, they make quicker decisions, and in fact, they have a tech stack that is much easier to integrate with. This is what is driving the high adoption of OpenTrade. That's how OpenTrade is growing so much and being able to serve customers in such short period of time. So the time to value is very short as we speak. So the principles of go-to-market haven't changed, but the sales cycles, the speed of adoption, and so on have significantly changed for sure.
100%. I mean, it's a very simple mental model. And Jeff and I used to sell blockchain-based software to large financial institutions, and the pain of that experience did inspire, in some part, our approach to who we've identified as our ICP. But those large institutions, an integration can take 1 to 2 years. We're doing them in 1 to 2 weeks.
I probably say that the market has changed. Maybe, Dave, you can say that maybe in the last, because of the regulatory frameworks, even more traditional financial institutions, and even Visa and Stripe and so on, are developing stablecoin rails, are being adopting those rails, right? So I think that might have changed. Not sure.
What's changed is that they're now comfortable to engage with stablecoins, but what hasn't changed is that very long, painful sales process and the fact that you're going to have to run a POC for a year, and it's very likely at the end of it you'll make no money and you'll get a press release, and that's kind of it. I still am not really sold on the idea that very large financial institutions are going to be the leaders in this space. I think that they'll probably be service providers to companies like Circle who carry the torch. It remains to be seen. Look, I mean, there's definitely, the Genius Act is definitely, I mean, you've got Brian Moynihan from Bank of America kind of coming out on earnings calls and saying we're going to build a stable coin. That's definitely a huge shift. But there's a lot of institutional bureaucratic inertia with those institutions that isn't going to change overnight.
My good friend Grok just helped me with some research here, because when we're talking about this and talking about Stripe, I thought I recalled that they had acquired a company in the stablecoin space recently. And lo and behold, Bridge, they acquired for $1.1 billion here in February 2025, which of course makes it their biggest acquisition to date. Do you consider this a competitor and a potential problem, or do you consider it validation of the solution and the need for this in the world?
Absolutely validation. So Bridge is a good example of someone who would be a customer of OpenTrade, right? They're a stablecoin enabled on-off ramp provider. Those types of companies have a need to earn yield and offer their customers yield as a value-added service. So some of our customers are competitors with Bridge. And so for us, it was just kind of slam dunk validation that, look, we're building a business in a space that is going to get very big very quickly, and that the infrastructure play, Bridge is sort of money movement infrastructure and we're yield infrastructure, that those types of businesses are going to be prime targets for incumbent fintechs looking to break into what is quickly becoming a huge market.
Then let's move to this whole topic of real world asset yield. And I maybe should go back to the start of the conversation where I said, well, isn't yield potentially solved by regulations then allowing you to just put 3% or whatever tied to the dollar yield, and then it's solved for, and you don't have to go and do workarounds and find real world asset yield?
We very much believe in the separation of church and state. And by that, I mean the separation between those that issue stable coins and those that provide services on those stable coins like yield. And the regulators have basically made that law, which is that stablecoin issuers and most major capital markets are prohibited from paying any form of yield. And that means companies like OpenTrade need to exist to transform those stablecoins into yield generating instruments. And
what's the foundational principle, Dave, for making that prohibited?
So a stablecoin, while technologically very different than modern money, from a business model perspective, is actually very similar to a concept that's been around for a long time called a narrow bank. The idea of narrow banking is that fractionally reserve banking, which is what most of our modern banking system operates on, where you take in $1 and then you're given license to create $10 worth of credit, meaning that if roughly over 10% of your customers ask for their money back at any given point in time, the bank is going to fail. People looked at that problem and said, we should actually have these special purpose payment institutions that are fully reserved. So for every dollar they take in, they hold $1 in very safe, liquid investments that can be liquidated immediately to repay depositors. That is what a stablecoin is. And so what you're seeing the regulators do is basically say, from a legal and regulatory perspective, we're going to make you operate like narrow banks so that we take run risk off the table for money that is inherently very flighty because it can move with the click of a button instantly. This isn't new, right? This is something that they've done with e-money basically since the invention of e-money. There's always been a prohibition on paying yield because the assumption is that if you're able to pay yield, then what you're doing is you're taking customer money and making illiquid, risky loans with that money, and that's going to create a problem.
So what real world assets are powering OpenTrade today?
We offer a huge variety of yield products backed by many different asset classes across the risk curve. So very safe, liquid money market funds and short-dated sovereign bonds like U.S. Treasury securities, through to commercial paper, which are short-term debt instruments issued by investment-grade companies, through to trade finance and trade receivables, basically assets generated from the financing of working capital, private credit, so secured and unsecured loans to private companies, publicly traded fixed income ETFs, and soon crypto and DeFi native yield strategies. So our option is our stance is that we're not an investment advisor. We're not providing any investment advice. We're not taking a bet on the direction of the market. We want to build as broad a range of investment options and yield generating strategies as is possible so that we can fit the need of any customer.
Do you inside OpenTrade build this investment strategy portfolio model that underpins the yield, or do you partner with an investment bank that then executes that?
We partner with regulated asset managers who do the structuring and underwriting and sort of financial design of those products. Now, we provide input based on customer feedback, but that's ultimately all of the portfolio design and management and risk management and trading activity is done by regulated asset
by
managers.
someone else. Yeah, because I was about to say, otherwise it becomes a huge shop. Yeah, interesting. Okay,
we are a technology company.
Yeah, exactly. Tell me, I don't know if this is public, how much money right now is run via OpenTrade, or has yield generated via OpenTrade?
So we've processed in the last year over $200 million in transaction volumes. Stable balances on the platform average about $65 million and growing very fast. We've had 9 months straight of 20% month over month growth. So we're really only just under 18 months like live, and I'd say, basically a year with real customers. So we've gone from zero to something that's becoming quite big very fast, and we expect really that to double or triple by the end of the year.
And I'll ask you, Itxaso, a real VC question. I won't ask you what's the TAM here, but I'll ask you what is the end scenario here? Is that all the money in this world that's run via stablecoin? Is that kind of the dream scenario, is that all of that goes via OpenTrade to get yield? Or on what layer, how foundational is it possible to imagine that a system like OpenTrade operates?
We start from the premise that people who are operating with digital currencies are pretty way almost financially savvy today. And so if you think about it, people who are financially knowledgeable, they don't keep their money in the bank just because they want to make money out of it. And so they are the early adopters of this world. First, I do think it's not necessary to have everyone that is using a stable coin earning yield to build a big business. Two, and I will let at the end Dave comment a little bit on how are they expanding on the product side in such a way that you can build a very big business out of that. But I do think that definitely you can build a huge 100, 200 million revenue business just providing yield.
Yeah, look, I mean, ultimately, we view yield as a starting point for our business. We think that the stablecoin market capitalization will grow to several $1 trillion very quickly, especially given the regulatory headwind that they have, and that our place inside of the fintechs building stablecoin powered financial services gives us a great position to expand into non-yield based stablecoin powered services, whether that's on-off ramps, cards, lending, and credit, virtual accounts, FX, you name it. We ultimately think that, OpenTrade can become, one of the de facto stablecoin powered financial services infrastructure providers and basically use the classic land and expand strategy where we're integrated into a customer, providing them yield and yield-based services, and that we can then cross-sell a very diverse line of very high quality products that are tangential and value added to yield. And in that world, that's not a few $100 million revenue business. That's a few $1 billion revenue business.
What type of returns can you expect? What type of yield can you expect when you use someone like you?
Because we deal primarily with real world assets, and now even increasingly with DeFi and crypto-based assets, they're always anchored in interest rates, right? Every financial product is anchored in interest rates. So yields fluctuate based on the current monetary policy and economic conditions. But today, we offer products that are very safe and liquid, and they yield basically the risk-free rate, which is around 4.25, up to much higher risk, higher return products between 12-15% returns. The products we're providing, we consider fixed income products, right? So we're not offering sort of let's 3x or 5x your money, right? If you want to do that, go trade Bitcoin. go trade a meme stock. Go trade Tesla.
Invest in Notion.
Yeah. Invest LP into a fund like Notion. Exactly. That's where, if you're looking to sort of XXX your money, that's what you got to do. But if you're looking to both preserve capital but also grow it, then that's where we come in, right? And so let's summarize it to say anywhere between 4 to 15%. Now, with that said, the product that we've built, both technically, legally, and operationally, could theoretically support any asset class. We've been very good about that. And we're now able to sort of launch a new product inside of 30 days. I think that's one of the things that got Notion so excited, was sort of the repeatability of the platform that we've built. But the choices that we've made in terms of the financial products that we offer through our platform has been driven by feedback from our customers and sort of what real world savers, both individuals and businesses, want. And so we're definitely on the lower risk side of things.
Itxaso, Dave is a pretty smart guy. How do you diligence a team that's building something like this? Because it is definitely not a simple business to build.
Dave's and Jeff's background was critical. To be honest, I think Dave already mentioned that they were working with digital currencies, blockchain for the last 10 to 15 years. They studied together, in fact, in the US, and they've been building businesses since they were at the school. So serial founders who built a couple of things very early on, went different ways, and in the end, they got together after having pretty similar experiences or in the same area, but not completely together, and they started building the business. So that's definitely a very important point. The second thing, it was very important because we are a B2B software infrastructure investor. We don't invest in digital currencies per se. We don't invest in crypto. We are backing an infrastructure play. And for us, it was very important to understand where that yield really comes from, right? As the underlying credit exposure of that stable coin, and making sure that first it wasn't based on a speculative activity in the back. It was real, it was transparent. There was a way to track where that was coming from. That was one. The second thing is that we also spend a lot of time looking at bankruptcy remote structures, collaterals, and how those assets are custodiized. We heard too many horror stories in the digital currency space. So ensuring basically that customers' funds are protected and are safe, right? So that's the second thing we looked at. And the third thing that we looked at is basically what was their regulatory strategy across the different jurisdictions, because those guys have customers in Argentina, in Colombia, and in many different countries, which are not necessarily obvious to us. The fact that, as Dave said, all those organizations, buyers, are also regulated themselves, gives you very good access to information, in fact, because they can provide information, they can provide their data, and you know how they are managing their businesses. So the conviction really came from seeing that yield doesn't come from speculative or unsustainable trading transactions, but rather from this real growth in stablecoin usage and transactions in the market.
Dave, before we go to the regulatory part, which I think we should talk a bit about, how do you pick an investor like Notion? What did you think about when you put together this round and decided Notion are the team to go with?
As an entrepreneur, it's actually pretty straightforward. You're looking for the largest investor with the best reputation and chemistry with the partner or GP that you're going to be interacting with and you're going to have on your board, right? And Notion has all those things, right? It's a very large, successful, well-reputed fund that has helped many different entrepreneurs and businesses go from 0 to 1. And so that gave us a huge amount of comfort that, look, they know what they're doing. And then just our interactions with Itxaso, like she just really leaned in and was so intelligent and got up to speed so quickly.
That's because I am on the call now.
No, I say this if she wasn't here, right? But I would say, believe me, because this is, a 5-10 year relationship that you enter into when you take money. And so we're very conscientious about who we do that from, and sort of Notion checked all of the boxes. It wasn't just what we saw on their website. We talked to other founders who had worked with Notion for varying periods of time and were in different stages, and they all gave very glowing reviews. And so for us, it was a pretty easy decision. They really are a fund that any founder would be quite privileged to have on their cap table and to be working with.
I always love it when our European funds get some love. Let me go to the, I was about to say, let's go to regulatory, but I think that it's more interesting and more broadly applicable for people to hear a bit about scaling your infra at the edge of fintech and crypto. So if I cue this up by saying that you've got $47 million under management and the 20% month-over-month growth, as you said just before, Dave, what are the scaling priorities that really keep you up at night right now?
This is a perfect question because it's actually 65 million now. So even from when we submitted that information till now, that's 50% growth from when you got.
And that was yesterday. No, it wasn't.
Yeah. So look, scaling starts with people, right? You got to get the right people into the business that can then put the systems and processes in place that allow you to go to add zeros onto the end of your transaction volumes, customer numbers, and AUM. And so the most important thing that we've done in the last year was grow the team. Not huge, right? You're talking about going from 6 to 12, but doing that very conscientiously and putting very high-powered professionals in place that had the combination of both experience, attitude, aptitude, and experience to operate this business. And so whether that's our chief operating officer who worked in senior positions at a large financial institution for 20 years and then built the first sort of bank-owned crypto asset custodian, through to our MD of sales who worked at that same company and sort of had a ton of experience selling, very important mission critical crypto-based systems to, large institutions, through to our engineering team. We've gone from our CTO, Tom, who's one of the smartest guys I've ever met, right? His PhD was in, chip building from Illinois Champaign, which is, as you know, one of the best sort of technical universities in the world. And he's built and run, large software-based businesses, startups through to Google and Meta, and the engineering team he's built up around. That's where it starts, right? And then we've used, time-tested, we evaluate the processes, we then identify the pain points, and we either solve them with people or systems. And so I think we've been very good and are in a very good position to add several zeros to our metrics and really not bat an eye. And so, yeah, suffice to say, scaling starts with people, and then everything else follows from that.
Itxaso, you've done a lot of work, both yourself, but also at the team at large at Notion on the scaling journey. Can you maybe talk a bit to what they've just shared here? Does it align with what you generally see, or have there been specificities, and how are you helped out?
At Notion, and I think, Andreas, you just mentioned this because you did a podcast, I think, with
with Stephen
Miller, who runs our platform team, but we've invested in more than 150 B2B software businesses. We've been able to learn from that and build a pretty practical playbook for scaling from 1 to 5, 25 to 50, and then getting obviously over 100 million. So we know the different challenges that the businesses face, from rethinking and scaling their go-to-market motion, to building enterprise credibility, to hiring the right leadership. So I think beyond capital, we really try to support our companies, and we have a dedicated team as well as a network of advisors that we look we use for that. I think Dave right now has been talking about the team and the go-to-market scale. I think on the team side, we've spoken a little bit with David about this, and he took a couple of our publications when he came to the office. But we are big believers of what we call the game changer mentality. And this was something that somebody that you might know, Andreas, Maddie Gross, who was our talent director for a while, and she's an incredible friend today. So she basically worked on an analysis, and the outcomes were that basically companies that grow the fastest are the ones that make big bets in one or two people early on, that are what makes the company grow much faster, right? For us, talent is very, very important. Dave knows that I've been meeting some of the early talent of the company, and I spend time with them, even being on the board. It matters to me. I know it matters to them. It matters for these early employees, and it matters also for the founders because they want to retain them. And so I spend a lot of time with the founders trying to help them build that, because at the end of the day, the most important part of the business will be built by these people. So definitely we've been working very close to Dave and to Jeff on this one.
Dave, is this VC lingo bullshit or is it real?
No, it's not. Look, that translates into very real, meaningful support. I think that's one of the things all of our investors have been so great about, is not just giving us the VC lingo bullshit, but, actually sort of rolling up their sleeves and helping us build this business shoulder to shoulder, and not just being critical and, kind of chucking questions over the wall, but, helping us look around corners. And like Itxaso said, also what she said, making big bets on a few people and then having them grow with the business over time. We're not, obviously there's always an element of sometimes you do need to bring in sort of a very senior outside hire and have them build a specific part of the business. But I would 9 times out of 10 much rather have that talent come from within the business and join early and stay late.
Dude, I'm about to hire someone who's going to be higher paid than me. So, so yeah. Fuck.
That is something that is going to happen, especially in a startup.
Yeah, the incumbents in this space, they're obviously massive, or at least in general fintech. Could you tell me a bit about how you interact with them? Are they actors that really try and make it difficult for a startup to live, or are they more open to work with you?
What's really interesting is before working on USDC, Jeff and I were, as I mentioned, selling blockchain-based software to large financial institutions. They were our customer. Now we are their customer. So the large financial institutions, the incumbents, so to speak, they are service providers to us, whether that's trading desks or brokerage or custody or cash management. We use them to power our product that we then sell to their competitors, which is really interesting. So we are focused on the challengers, right? The up and comers, the ones that are building sort of the next wave of things. Now, ultimately, look, I do think that there is an element of we're focused on the early adopters. There's so much low hanging fruit, but then there's the fast followers. And that's where we'll start to see more sort of traditional or incumbent or scaled fintechs join the ranks of OpenTrade customers. But right now it's, the companies that are growing the fastest and making the biggest dent are not the incumbents. It's the challengers. For us, it's incredible because, as Itxaso mentioned, like that means our sales cycles can be 2 or 3 months instead of 2 or 3 years. And look, a lot of the incumbents aren't exactly ready right now. Like they've come around, right? We've got the Genius Act passed. No one's worried that stablecoins are going to become illegal anymore, but there's still a lot of work. There's still a lot of time that is going to transpire before you see, huge sort of financial institutions adopting this technology at any meaningful scale. What you'll see first is like the Stripes and the Robinhoods who've been very vocal about sort of their vision for the future, and that stablecoins and tokenized assets will be a big part of that. But even there, it's still at the margins of what they do.
I have one final question, and that's for you, Itxaso. I'd love to ask you, how should B2B investors think about this opportunity in the crypto real-world asset infra space?
Yeah, it's interesting because I don't think many institutional investors are yet making the shift. And so we clearly, when we made Dave, first of all, I would say to the investors that there are many people like Dave who have been working in the digital currency space and blockchain space for many years, and they are looking for more traditional infrastructure software investors to get in the roster, because Dave wanted to have both the visionary crypto savvy investors as well as the infrastructure ones. So I do think founders of those businesses are looking for traditional investors to get in their cap tables. So I do think that's very important. But why now? Obviously, we are seeing a real institutional shift, the regulation, they are setting up clear frameworks. And I know everybody is against regulations, but the reality is that some of those regulations create a good space for more traditional players to trust, to know what they can do and what they cannot do. And I think that it's important to move from that experimentation to real adoption of those tools. And the second one is that demand side is unquestionable. That's what it is. Stablecoin is already processing trillions of transactions, as we said. And those users, customers, are seeking for safe ways to move their money, to transact with their money, to do more with their money, to earn yield, and to do everything that they can do with their traditional banking systems. So I think definitely there is an opportunity, and now is the timing.
Itxaso, Dave, thank you so much for joining me on the podcast today. I really hope you enjoyed it as much as I did. And I don't think I made too much of a fool of myself, despite not being exactly an expert in real world yield and stablecoin.
Not at all. It was awesome. Thanks for having us.
It was great. Thank you, Andreas.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, Skytech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to Skytech this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.